Ancient Greece did not have a modern economy, but by the 6th, 4th centuries BCE, it had developed remarkably sophisticated financial institutions centered on temples and city-state cooperation, with the Temple of Apollo at Delphi acting as a major financial hub where over 1,150 Greek city-states placed deposits, borrowed money, and engaged in long-distance credit transactions, creating a network far more advanced than most people realize, and in many ways a precursor to later banking systems in Rome and medieval Europe. This Delphi financial system included multi-level credit, asterisk loan issuance with collateral, marine insurance for sea trade, futures for agricultural products, and deposit accounts that acted similarly to modern checking and lending functions, and even complex instruments akin to bonds or credit notes, remata, which meant that economic activity was closely tied to trust, reputation, and temple authority, rather than coin circulation alone. At this time, Greece was transitioning from barter and local trade to interconnected commercial networks, supported by silver coinage introduced from Lydia in the 7th century BCE, and expanding markets known as agora, where goods, credit, and capital flowed beyond islands and city-states into the wider Mediterranean trade networks. Naturally, this expansion fostered speculation, accumulation, and risk, especially in maritime commerce, where shipping investments could yield extraordinary returns or catastrophic losses, depending on weather, piracy, or harvest outcomes, making finance both central and dangerous. The economy was also uneven because land was limited and agricultural productivity varied widely across regions, leading many city-states to borrow from institutions like Delphi to fund wars, public works, or trade expeditions, which increased systemic exposure to defaults and risk contagion across the Greek world long before the word economics was ever used, creating conditions where an interconnected network could be deeply affected by natural disasters or trading shocks. This sets the stage for what historians refer to as the first recorded large-scale economic downturn in Greek history around 373 BCE, when credit stretched too thin, debts went unpaid, and markets that relied on confidence and enforceable contracts experienced a severe contraction. The financial empire at Delphi was built on trust, temple authority, and political cooperation rather than sovereign states' ability to tax large populations. And while this created a remarkable level of sophistication for its time, enabling international loans, credit guarantees, and even futures and insurance, it also created systemic fragility because the temple's authority and reputation were the only enforcement mechanism for cross-city borrowing and repayment, meaning that when real shocks hit the system, there was little institutional firepower to absorb the damage. Among the most significant tools used by Delphi were hoi thesauroi, treasure deposit accounts where city-states stored wealth, tokos, interest-bearing loans, and grammata, credit instruments transferable between parties, which effectively created a proto-banking system that underwrote wars, infrastructure, and investment long before centralized national banks existed. But this also meant that a default by one major player could ripple throughout the network, because credit was densely interconnected and often over-leveraged relative to the actual silver reserves held at the temple. Krishna et Ali argue that the absence of legal institutions capable of enforcing repayments outside local city-state jurisdictions effectively made the entire system reliant on religious oaths and reputational mechanisms, which worked well in times of prosperity, but offered no clear means of debt restructuring or systemic bailouts when multiple defaults occurred simultaneously. Meanwhile, economic growth in Greece in the 5th and early 4th centuries BCE had been buoyed by expansion in trade, colonization of new markets, redevelopment of cities, and military campaigns that were often financed through borrowing from Delphi and other lenders, which expanded short-term liquidity but also increased long-term leverage, creating a situation where the financial system was highly sensitive to climatic events, war destruction, and shipping losses, the exact types of shocks that would later trigger the historic asterisk credit contraction and downturn around 373 BCE, when heavy maritime losses, defaults by key borrowers, and real economic stagnation strained the faith of lenders and debtors alike, causing the value of credit to shrink and pushing city-states into economic distress that historians identify as one of the first recorded financial contractions in the ancient world. The year 373 BCE stands out in Greek history, not because a war was fought or a treaty signed, but because it marks what ancient evidence suggests was a major financial contraction tied to the Delphi banking network and broader commercial disruptions, a crisis driven by simultaneous shocks that overwhelmed ancient credit structures and precipitated defaults that reverberated across the Greek world. Among the contributing factors were long-distance maritime losses, possibly connected to natural disasters such as the Delos tsunami, which destroyed much of the merchant fleet that city-states relied upon for trade and income, causing widespread inability to repay loans and triggering cascading debt failure, a phenomenon akin to modern liquidity spirals where initial losses beget more defaults and confidence collapses, forcing lenders to restrict new credit and causing markets to dry up. The impact of this downturn was severe because Greek economies were tightly linked through trade and credit, meaning that a default in one region quickly affected partners in other regions, with some city-states abruptly unable to finance grain imports, pay mercenaries, or support civic projects due to sudden credit scarcity, leading to internal political strife, reductions in public spending, and even migrations as economic insecurity unfolded remarkably. This early financial collapse carried socio-political consequences that mirrored modern financial crises. Elite creditors lost faith in distant borrowers, ordinary citizens saw a contraction of liquidity in local markets, traders and artisans experienced dramatic drops in demand, and political leaders faced uprisings from impoverished constituents who blamed both domestic elites and external debt obligations for their hardship. Compared with modern analogs, this ancient collapse highlights that financial systems fail in similar structural ways, despite vast differences in technology, institutions, and scale. When credit contracts rapidly after widespread losses, confidence evaporates, and economies spiral downward, often with long periods of stagnation and recovery, effects that the Greek world felt deeply as regional economies weakened, alliances shifted, and social tensions increased. After the catastrophic downturn of 373 BCE, Greek city-states and financial centers such as Delphi confronted the hard reality that systemic shock had exposed deep flaws in ancient credit mechanisms, prompting a variety of responses that can be understood as early attempts at economic stabilization, legal reform, and risk mitigation, albeit constrained by the cultural, political, and institutional limits of the time. In the decades that followed, city-states sought to reduce excessive reliance on temple credit by developing more localized financial arrangements, restricting the most onerous forms of interest, and codifying repayment standards in specialized courts to resolve disputes instead of relying solely on religious oaths at Delphi. Some communities introduced reserve stores of silver or grain to cushion future shocks, and there is evidence that interest rate ceilings and stricter documentation requirements were implemented to enhance predictability and reduce speculation, indicating ancient financial thinkers were already grappling with questions of moral hazard, credit discipline, and systemic risk. Socially, the crisis forced elites to negotiate with indebted farmers, small traders, and veterans who had taken loans to support wars or investments, absorbing some losses in exchange for civic stability, while in the cultural sphere, tragedies and philosophical literature began to reflect greater awareness of economic uncertainty, risk, and human vulnerability, a pattern seen later in Roman and medieval economic thought, illustrating how economic collapse forces societies to innovate legal and financial norms. While recovery was gradual and uneven, by the later classical period, the Greek world had re-established more diversified economic networks that combined maritime trade, localized lending, and cooperative financial institutions, suggesting that extreme downturns, even in ancient economies, can stimulate institutional adaptation and pave the way for more resilient systems. The first recorded financial collapse in ancient Greece around 373 BCE is not just a historical curiosity, but a powerful reminder that fundamental dynamics of credit, confidence, systemic risk, and contagion are deeply rooted in how economic actors interact with uncertainty. Despite the vast differences between ancient and modern financial systems, the collapse demonstrates that when credit networks are tightly interconnected, when enforcement mechanisms are weak, and when systemic shocks occur, economic contraction follows. A lesson echoed in every subsequent major financial crisis, including the 2008 global financial crisis and the European sovereign debt turmoil of the 2010 seconds, where confidence collapses, defaults, and contagion required institutional bailouts and reforms, showing that while institutions and technologies evolve, the underlying vulnerabilities in financial systems persist, reinforcing the need for robust legal systems, diversified credit mechanisms, and risk management frameworks in order to absorb shocks rather than amplify them in ancient Greece. The collapse led to centuries of adaptive responses, local financial innovations, and a cultural understanding of economic risk that arguably influenced later Hellenistic and Roman economic practices, leaving a legacy that reminds us that economic systems, no matter how advanced or ancient, are always social constructs subject to failure, adaptation, and transformation under stress.